Good evening, Professor. The Banking Union of the European Union is a transfer of responsibility for banking policy from the national to the EU level in several EU member states, initiated in 2012 as a response to the Eurozone crisis. The need for a banking union emerged from the financial crisis of 2008 and the subsequent sovereign debt crisis. It became clear that, especially in a monetary union such as the euro area, problems caused by close links between public sector finances and the banking sector can easily spill over national borders and can cause financial distress in other EU countries. The members are Gabriel Tompis, Sarthak Tayal, and David Zul. We start with a summary of the presentation. We start with an introduction, followed by the purpose of the union. Then we talk about three pillars of the European Banking Union: the single supervisory mechanism, the single resolution mechanism, followed by the European deposit insurance. Subsequently, we end with future importance of the union and discuss a certain few examples.
Introduction into the Union. The Banking Union is Europe's response to the Eurozone crisis in 2009. It was created in 2012 with the objective of transferring the responsibility for banking policy from national levels to EU levels. The Banking Union consists mainly of three pillars: the single supervisory mechanism, the single resolution mechanism, and the European Deposit Insurance Scheme. These three pillars are based on the financial regulatory framework, also known as the Single Rulebook. Purpose of the Union. The purpose of the European Banking Union is to make the banking system more transparent, unified, and safer. They're planning to do this by consistently applying common rules and administrative standards for supervision, recovery, and resolution of banks. They're trying to get all the banks in the system more unified by treating national and cross-border banking activities equally and the linking the health of the banks with the health of the country they're located in. And finally, they're planning to make the system more safe by intervening early if banks face problems and, by doing this, preventing bank failures. The banking union after the financial crisis. The financial crisis pointed out a lot of weak spots in Europe's financial system. There was a lot of fragility in banks in the Eurozone. There was a lot of problems with credit, sovereign and national credit. And basically, the financial health of the banks depended on the financial health of the country they were located in. All these weak spots point out the need for regulation, for new laws, for the implementation of new laws to make it more safe, more stable system. In response to this financial crisis, the European Commission implemented a new rulebook in which they presented a series of initiatives in order to create a safer financial sector. Some of these initiatives are strong prudential requirements for banks, improved protection for depositors, covering up to 100,000 euros in deposits, and rules for managing failing banks.
Now we go to the first pillar of the banking union. The first pillar of the banking union is the single supervisory mechanism, where the ECB is the central prudential supervisor. All financial institutions within the euro area are directly under the SSM, and all countries can join. The main responsibility of the ECB is to supervise the largest banks within the SSM. National supervisors continue to monitor the remaining banks, and together with the ECB, they check that banks comply with the EU banking rules and tackle problems early on to prevent issues and risks within the banking sector. Some aims are to ensure the safety and soundness of the European banking system, increase financial integration and stability. After the SSM identifies a bank as failing or likely to fail, the SSM gives the case to the SRM, also known as Single Resolution Mechanism, where it is going to go through the process which I'm going to explain in the following slides. Welcome to a very important part of the banking union, the Single Resolution Mechanism. As mentioned before, after the SSM identifies a bank as failing or likely to fail, the case is given to the SRM. The Single Resolution Mechanism is the second pillar within the banking union. The mechanism has the foundation on two bases: the Single Resolution Board and the Single Resolution Fund, which is financed by the banking sector. In the well-known financial crisis of 2008, we experienced a banking sector-based worldwide economic crisis, which teared thousands of persons into poverty and showed the importance of a stable banking sector regarding the overall economic activity. As a reaction to the financial crisis of 2008, the mechanism was introduced to ensure an orderly resolution of failing banks with minimal costs for taxpayers and to the real economy. In addition, it had one really important goal: to end the so-called too big to fail problem. As mentioned before, the mechanism is based on two separate components, where the Single Resolution Board is a fully independent EU agency acting as a central authority. With other national resolution authorities, they all together form the SRM. They have two missions. First, they manage the fund, and second, they consult failing banks. The SSM board, however, works closely with the ECB, the European Commission, and European Council. The purpose of the mechanism is to strengthen the confidence in the banking sector, as after the crisis of 2008, the whole banking sector had a very bad reputation. Furthermore, the crisis had an immense impact on the trust of bank customers, as they were afraid of losing their money. Therefore, customers started to get the money in cash. This phenomenon, bank run, is one of the other goals which the SRM wanted to prevent. Last but not least, the SRM wants to try minimizing the past-based negative relationship between banks and states. With those goals, the SRM prevent further financial crises, as those different requirements lower the risk of having a crisis. Within the banking union, the Single Resolution Mechanism is the process unit which is being applied for all banks failing or likely to fail. It is a very important part of the three-pillar-based banking union, as it determines whether or how to intervene into the unhealthy bank. Here we can see the pathway on how the board of the SRM processes in any case of failing or being likely to fail bank. In the first step, the board tries to find private sector solutions, mostly finding investors or other fundings to invest into a bank. If there are no interests from the private sector, they check if the resolution is in interest of the public sector. As seen here, we have the different steps: banking identified as failing or being likely to fail, and the executive board of the SRB sees the bank and tries to find any solution. As soon as the SRB checks the previous 2 points and proposes the resolution scheme to the European Commission, the Commission then has different options to whether accept the scheme or not. Depending on what are their counter-arguments, they involve the European Council when it comes to questions of public interests or of the Single Resolution Fund. Important. We need to mention that while being in the process, the failing bank or the analyzed bank can always be declared as wound up, as here in the red quaders. What means wound up? Wound up means that the bank is going to go out of business because the SRM decides to not intervene into this failing bank. The SRM has different tools to help the bank. The most important ones are sales of business, bailout, and asset separations. When the European Commission and the Council gives green light within maximum of 24 hours, the SRB can introduce the resolution scheme to save the unhealthy bank. This procedure doesn't just save the one bank, but it controls banks likely to fail on a constant basis, so that crisis can be prevented. As we all know, the banking sector is very, very well connected, and the chance of a domino effect is huge. Once a bank fails, this could mean cheering a whole economy into a crisis, such as in 2008. Even nowadays, proven in the last failing hedge fund, Argos, where several international banks were involved, shows us how globalized banks are, especially in the matter of investments. After explaining the importance of the SRM, we now mention some important relevances which the SRM provides. First, the spillover of crisis to non-participating member states, meaning if there is a banking crisis, for instance in Switzerland, that it won't spill over to a financial crisis in Spain, as it happened in 2008, where the financial crisis started in the US and then teared down the whole European financial system. More, prevent banks from being dependent on taxpayers, meaning that they can do whatever they want and at the end they're going to be saved by the taxpayers paying taxes to governments and governments bail out the banks. One of the most important parts is help to avoid situation in which bank resolutions at national level would have a disproportionate impact on the real economy, meaning you try to save banks even though it doesn't make any sense, tearing apart the whole economy and leading to a recession.
We now talk about the third pillar of the European Banking Union, known as the European Deposit Insurance Scheme. It is an effort to take away pressure from the banks and provide guarantees and support to the depositor by creating a mechanism that allows compensation for bank failures and insolvency. This highlights the benefits of being in a monetary union and how it helps in taking away pressure from a particular nation and a particular domestic economy. The model explains on how the EDIS is better than the domestic banks as it provides state-backed guarantees and helps in the economic well-being of people as it also affects economic policy. A key term in this pillar is the deposit guarantee schemes. These are schemes in which, in case of solvency of a bank, a limited amount of money is given to the depositor as compensation for their loss. This was implemented to deepen economic and monetary bonds in the European Banking Union. The compensation as a key fact, is done by using money that is not paid by the taxpayers and only uh, transferred from other commercial banks. EDIS would provide a stronger and more uniform degree of insurance cover in the euro area. This would reduce the vulnerability of national DGS to large local shocks, ensuring that the level of depositor confidence in a bank would not depend on the bank's location, weakening the link between the banks and the national sovereigns. EDS would allow deposits below 100,000 euros of all banks in the banking union. When one of the banks is placed into insolvency or in resolution and it is necessary to pay out the deposits or to finance their transfer to another bank, the national DGIS and EDIS will intervene. The scheme will develop in different stages and the contributions of the EDIS progressively increase over time. It is a measure that has been applauded by the world and has something that is really, really benefited the European Union.
In our opinion, there are three main importances of the banking union. First, the regulation of the globalized banking sector. Second, a sustainable cooperation between governments and banks. And third, a constant economic growth. As our world gets more and more connected and globalized, a centralized and standardized union which implies rules and requirements for banks is needed. Not just because banks get bigger, but because they are becoming more important for stable growth of the economy. In addition, as we as a world are being challenged by external disasters such as COVID-19 or climate change, a sustainable and strong banking sector is vital for the world population. Moreover, a constant economic growth helps not just developed countries but as well developing and least developed countries to receive a certain living standard.
So, we have talked about the purpose of the union. We have talked about the three pillars of the union. Now, we're going to give some examples of what this union, the rulebook, is trying to assess, is trying to prevent. We traveled back in time in 2008, right in the financial crisis. We have these two banks. There's Lehman Brothers, that was a huge investment bank, one of the fourth largest in 2008, and UBS Bank, that's one of the 30 largest banks in the world, a Swiss bank. Lehman Brothers was located in the United States mainly, and basically in 2008 there was a lot of bailouts. We talked about before we talked about how the financial health of banks depended on the financial health of the country. In Lehman Brothers case, it doesn't depend. Yeah, United States was strong and solid, but in this particular situation, we're having a lot of trouble with plumbing of the stock market, and there was a lot of trouble with credit, same as Europe. But we want to talk about why Lehman Brothers didn't receive a bailout and why UBS did. This is one of the problems that the banking union is trying to assess. It's trying to make the system more equally for all banks. And basically in 2008, Lehman Brothers went bankrupt. They couldn't pay the debt. They had like $618 billion in debt, and they couldn't. There was low liquidity in all their assets, and they couldn't pay the debt basically. So there was a lot of the political climate in the US at the moment, that's very difficult. They were against bailing out another investment banking. So it's one of the reasons why Lehman Brothers didn't receive a bailout. On the other hand, the UBS, the Swiss bank, did receive a bailout. And I don't know the particular reasons for this, but this is proof of the inequality on the at the financial system. We are not talking about two firms, two European banks, but it's a great example for us to understand how this impacts people in these countries, in these continents. In 2008 also, all these bailouts, all the money came from taxpayers after the financial crisis. This is one of the problems that the union is trying to assess also. So now we have funds, the banking union has funds that will pay for these bailouts in the future, hopefully.
So, ladies and gentlemen, dear guests, we come to end. Thank you so much for listening, and we hope you had a good time and you could learn a lot. Thank you very much and stay healthy.